guys, hope all of you are doing mind-blowingly amazing and your studies are in full swing. To fuel up your studies, I am coming up with a superb revision for you to get over with costing in less than 3 to 4 hours, guys. Yes, you heard that right. Entire syllabus, everything that you need to know about the syllabus gets over in 3 to 4 hours. I am actually pretty grateful to KM sir to make sure this is coming to you, this is reaching to you. My name is CA Nimeet. I am a chartered accountant and a company secretary from Bombay, and I've been teaching this subject for more than 250 batches now. And this is my best creation that I have ever created. That is a formula book. Everything, everything, mind you, every goddamn thing that you need to know about the subject is over here, and we are going to revise this material to make sure that you leave nothing behind and everything is done to the best. So this is the book that we are going to revise in this video. The video description will also have the book over there. You can download the PDF from over there and it is all with you. Just open your PDF and start watching your video, and I am assuring you that by the end of 3 to 4 hours you will be learning everything that you need to know and everything quickly. Yes. Now this is my costing formula book and it has all the chapters in it. I am starting off with the first chapter, which is materials. Now, materials as a chapter, we have variety of things in the chapter, but the quintessential important thing that we have in material is EOQ. EOQ is basically economic order quantity. Now, I'm not sure if you know it, but this is a name that you should be knowing. The EOQ is also called Wilson square root formula. So this is the name of the formula. Please make sure that you are writing this name in the question paper, in the answer paper, sorry, making sure that everything is mentioned in it. This will give you those brownie points. This will express the examiner that you know your topic, your subject in depth. Now, the entire idea of EOQ started from the fact that total ordering cost is equal to total carrying cost. Now, how do you get total ordering cost? Total ordering cost is uh, number of orders into ordering cost per order. How do you get carrying cost? Carrying cost is half of EOQ into CC Buba. That is carrying cost per unit per annum. Now, how do you get number of orders? It is AD upon EOQ, annual demand upon EOQ, into ordering cost per order, which is equal to half of EOQ into CC Buba. Now, if you keep the EOQ aside, what do you get? Keep the EOQ on the left hand side, push everything on the right hand side, what do you get? So you have annual demand into ordering cost per order. This half will become 2 over there. So into 2, and the CC Puba is multiplied, so it gets divided into the EOQ and the EOQ. This is divide, goes there, gets multiplied, so becomes EOQ square, and then if you put it on the other side, it will become root. So EOQ is root of 2 into annual demand into ordering cost per order upon CC Pupa. This is your derivation of the formula. The name of the formula is Wilson square root formula. Please make sure that you mention this every time you write the formula. And this is how the formula is derived. Now, there are a few things that you need to know before you put down this formula. The demand will always and always have to be annual. The ordering cost always and always has to be per order, and the carrying cost always has to be per unit per annum. So the demand has to be annual, ordering cost has to be per order, and carrying cost has to be per unit per annum. Pupa. So how do we say the demand has to be annual, the ordering cost has to be po, that is per order, and the carrying cost has to be pupa. So po pupa. Po is per order, P is per unit, Pa is per annum. So po pupa, and that is your formula. So once you have the formula, there are a lot of smaller formulas as well, which I have recorded over here. So you have number of orders as AD upon EOQ. The total ordering cost is number of orders into ordering cost per order. Average inventory is half of EOQ. Total carrying cost is average inventory into CC Pupa. Total variable cost. This is the total ordering cost plus the carrying cost plus the materials purchase cost and comes in the frequency of orders. Frequency of orders is what? In how much time will you place an order? So you will place an order how many times? You have to complete the orders in 360 or 365 days. Divide that by the number of orders. Let's say you want to place 10 orders in 360 days. So in 10 orders, in 360 days, you have to do 10 orders. So every order has to go in every 36 days. So that is basically 360 upon the number of orders are 10, 36 days. That is how it is calculated, the frequency of orders. This is everything that you need to know about your EOQ. Now, we have already discussed this. Uh, Now, that is when the UQ does not have discount. But we have questions where UQ has discount as well. There are two types of questions in that. One where they'll give you a range that less than 500 units if you order, this is the price. From 500 to 600, that is the price. From 600 to 700, that is the price, etc., etc., etc. In that type of question, you will have to have this table. So now, Institute has a habit over here. They either give you less than 50 or less than 500. As your first range, it will be either less than 50 or less than 500. In fact, I will show you the question as well. Just a second. Uh, ah, this is the kind of question that I'm talking about. Less than 50, 500, 50 to 100, 100 to 200, 200 to 300, and 300 and above. They have given you different price ranges over here. Now, in such a situation, what do? We draw this table, and with the help of this table, we are able to get our answer very, very simply and quickly. So, here, our first column is order size. Now, if you have been given less than 50, choose 40 in that. If you've been given less than 500, choose 400 in it. Now, why? There is no particular reason. You can choose any number in that range, but Institute chooses 40 or 400 as the first slab. So we also do that. And then whatever is the lower end of the other slabs, that is what you will be choosing. So in the less than 50, you will choose 40, then 50, 100, 200, and 300. Are we understanding? So this becomes our first calculation, which is the order size. Once you have the order size, the next thing that you will have to put up is number of orders. How will you get number of orders? PD upon the order size. That will give you number of orders to get total ordering cost. Total ordering cost is number of orders into ordering cost per order. Yes. Then comes in the average inventory. See, please understand what is our goal over here. We have to find the total variable cost. What is total variable cost? Total ordering cost plus total carrying cost plus materials purchase cost. Right? So here we found out the total ordering cost here. Now for total carrying cost, what do we need? Average inventory into CC Pupa. So we'll calculate the next calculation, which is average inventory, half of your order size. Then the total carrying cost is basically average inventory into CC Pupa. So we'll do that. Then comes in the materials purchase cost. How much ever is your annual demand into the purchase price, and then you will get the total variable cost by adding total ordering cost, carrying cost, and material purchase cost to get your total variable cost. That's it. That's it, my dear friends. That's all that you have to do over here, and we'll get you your answer very, very quickly. Now, there is this one thing that you need to remember. In the total carrying cost, you have to multiply by CC Pupa. Now, the Pupa, how will you get that? Whatever is the applicable rate into the percentage. So here, what do I mean by that? For example, the rate is 9,600 and the percentage is 25%. So 9,600 into 25% is your CC Pupa for the first slab. But For the second slab, it will be 9360 into 25%. For the third slab, 9120 into 25%, so on and so forth. So whatever is the applicable rate into the percentage is what we have to do over here. Are we understanding? That takes care of the first type of EOQ with discount question. The second type is where they will give you that the supplier wants to give you 5% discount if you buy in bulk quantity. Whatever is the bulk quantity, they will tell you, but you will have to see whether the discount offer should be accepted or not. Now, for that to happen, what you will have to do? You will have to first find out total variable cost at EOQ. You will find your EOQ very easily. Then you will find your total variable cost at EOQ, which is total ordering cost, carrying cost, and material purchase cost. Now, if you are at EOQ, the total ordering cost and carrying cost will remain the same, and the material purchase cost you will have to add that. But in the proposed terms, you will have to calculate total ordering cost, you will have to calculate total carrying cost and then the material purchase cost. But when you are doing total carrying cost, you will have to be careful of one thing very, very, very much. That is your CC Pupa. Now, the per unit price will have a discount. So you will have to take the rate on the discounted price and not the regular price. So whatever is the CC Pupa over here, it will not be the same over in the proposed terms. Why? Because your per unit price has reduced, my dear. So since the per unit has reduced, the per unit into per annum, that is what we have to put down over here. You will have to take the discounted per unit price. Okay. Wherever the total variable cost will be lesser, that is what you have to choose. If it is lesser over here, accept the discount terms. If it is not lesser, then go with the UQ. Simple. Now, the next category that we have is stock levels. Now, stock levels runs on two things. Stock level runs on consumptions and lead times. What is consumption? Segregated as minimum, maximum, average. And lead times are segregated as minimum, maximum, and average. So you'll have three types of consumptions and three types of lead times. Okay. Now, as you can see, there are two formulas over here, the regular formula and a yellow highlighted formula. Now, when to use the yellow formula? If the question mentions safety stock in it, if the question mentions safety stock in it, then use the yellow formula, otherwise use the regular formula. Now, my dear friends, please keep this one thing in mind. These formulas are indicative in nature. There is no mathematical derivation to it. There is no backing to it. There is nothing of that sort. These are only indicative in nature. These indicate that you may have this much amount of stock with you, but these are, again, as I said, not conclusive, only and only indicative. Okay. Now comes in the reorder level. The reorder level is maximum consumption into maximum lead time, or if you are using the yellow formula, that is, the question mentions safety stock, then it will be safety stock plus average consumption into average lead time. Then reorder quantity, it is basically EOQ. But why do we call it ROQ then? It is because your EOQ can be your ROQ can be anything apart from EOQ as well. For example, let's say over here you accepted the proposed terms. Since you have accepted the proposed terms, you will not order EOQ quantity. You will order the ROQ quantity, which is this. For example, the EOQ is 1000 units and under the proposed terms, the order size is 2000 units. So will you order 1000 now? No, because you have chose the proposed terms. So it will now have 2000 units in it. Are we understanding? So 2000 units is what becomes your reorder quantity. So basically, reorder quantity is a wider term. It includes EOQ or any other quantity apart from EOQ that you may choose. Are we understanding? The next formula, minimum stock level. Minimum stock level has only one formula, reorder level minus average consumption into average lead time. Maximum stock level, two formulas, reorder level plus reorder quantity into uh, minimum consumption into minimum lead time, or the yellow formula is safety stock plus EOQ. And then comes in the average stock level. Average stock level is again two. it is minimum plus maximum by 2, or it is safety stock plus half of EOQ. That becomes your average stock. Danger stock we have only for one or two questions, which is average consumption into lead time for emergency purchases. And then comes in the safety stock. Safety stock is average consumption, basically annual demand upon 365, 52 or 12. This is average consumption into maximum lead time minus minimum lead time. Now, why are we writing 365 or 52 or 12? It really depends on your lead time. If the lead time is given in days, then you will divide by 365 days. If the lead time is given in months, you will divide by 12 months. If the lead time is given in weeks, you will divide by 52 weeks. Is that clear? And coming to the last segment, the miscellaneous segment, here we have only two formulas. We have inventory turnover ratio. The formula is COGS upon average inventory. How do you get COGS? COGS is opening plus purchase minus the closing, and average inventory is opening plus closing by 2. This will give you the inventory turnover ratio in times, number of times, and then the comes in the inventory turnover ratio in days. So that will be 365 upon the inventory turnover ratio. That is what is your inventory turnover. That is about it of the formulas in this chapter that you need to know. And anything and everything that you need to see further, we have the KS subscription model. You can start watching from over there. Every question is done in detail, and also we have done the maximum number of questions that you need to do. We have covered 25 years of papers, RTPs, mocks, everything, boss. So that is the best place to be at to cover your marks, and I can assure you, reasonable assurance, that 70% of the paper will be from the book that we are doing. Yes. So go back, and if at all you're preparing for the next attempt, get into the subscription and start watching right away. I am going to take a short break. I have completed material. Give me a while. I'll come back and do labor. Yes, guys, continuing the topic and starting with the next topic. Oh, so sorry. I forgot one part of the material chapter, which is cost per unit. Cost per unit is now a very new entry. All you have to remember is cost per unit is anything before the per is your numerator, and anything after the per is your denominator. So if you want to find cost per unit, it is total cost divided by total number of units. Now, how will you take the total cost? So any kind of discount that you have been given, you will have to reduce it except cash discount. For taxes, if there is any kind of tax for which credit is available, then you take that. That will not be a cost to you. Why? Because credit is available. If the credit is not available, you will add it in your total cost. Okay, so taxes, if credit available, do not count it as cost. If credit is not available, count it as cost. Any abnormal cost, damage, fine, penalty, anything, they will not be added to your cost. Anything that is partially refundable. Let's say I give you a can filled up with the material, and I will take back the empty can. I will give you the can at 100 rupees, but when you give it back, I will give back 50 rupees to you. So what is the net amount that is going out? Only 50. So that becomes your amount. Okay, and then the final the units are to be divided only by the good units, that is the units after the normal losses only reduce the normal loss. Let's say normal loss is 2%. You called for 10,000 units and 2% is normal loss, so you will get 9,800 units. These are the number of units you will divide it by. That's it. Now the next chapter that we have is employee costs or direct expenses. Here we do not have a lot of formulas, but we have methods of wage payment. The most simple method is the time rate basis, also called as guaranteed wage rate, where you will be paying, sorry, where you will be paying the hours worked into the rate per hour. Simple. The second method is your piece rate, that is the number of pieces into the piece rate, which is over here. The extension to your labor costing, where you are paying on the basis of time, you may also be paid overtime. Now, be very careful with overtime. Overtime has two types. There is a overtime rate, and then there is an overtime premium. Now, please understand what you pay as overtime. Once again, rate is basic rate and the overtime premium together. So, for example, let's say the basic rate is 10 rupees and the overtime premium is 50%, meaning on the basic rate you will be giving 50%, meaning 5 rupees as premium. So your overtime rate is 15 rupees. So there is a difference between the rate and the premium. Premium is the extra amount, rate is basic amount plus the premium amount both together. Institute may give you a question where you may get a little confused over here, so be a little careful. If they say overtime rate, it is basic rate plus the premium. If they say overtime premium, it is only the additional rate. Is that clear? Now, PC rate we have already discussed. Under the incentive schemes, now you have two types which you already know very well. One is the Halsey scheme, the other is the Rowan scheme. Now, what happens under the Halsey scheme? Earnings are hours worked into rate per hour plus 50% of time saved into rate per hour. Now, very important is to understand hours worked into rate per hour is your basic wage. This is the amount that a worker is going to get no matter what. The 50% of time saved into rate per hour is your bonus amount. Yeah. So here the basic plus the bonus is your earnings. There may be a situation where the bonus is zero. So in that case, earnings are only basic wages. But there will be most likely a case where the worker is getting bonus as well. So basic wages plus the bonus will become your earn. Is that clear? Now, next comes the Rowan scheme. Now, what happens under Rowan scheme? Hours worked into rate per hour, that is the basic wages, which is anyways there, plus time saved upon time allowed into time taken into rate per hour. This is your bonus amount. So again, same thing. The basic worker will be getting no matter what. Bonus is something that the worker may or may not get. Okay. So if the worker gets bonus, the basic plus the bonus is your earnings. Okay. Now, what are the elements that you need for the Halsey and Rowan scheme? You need time allowed, time taken, time saved, and rate per hour. These are the four elements. Time allowed, this is the time that you will be allowed to actually manufacture the units. For example, if you made 10 units, the time allowed is 1 hour per unit. So for 10 units, what will be the time allowed? You actually made 10 units. If 1 hour is what it takes, is supposed to be taken for 1 unit, 1 hour is supposed to be taken for 1 unit. For 10 units, how much will be the amount of hours that you should be allowed? If you are allowed 1 hour for 1 unit, for 10 units which you have actually manufactured, you will be allowed 10 hours. The time taken is the actual time that you have taken in the process of manufacturing. It could be less than 10 hours, it could be more than 10 hours. Let's say it is for now 8 hours. So, what is the time saved? You were supposed to complete the job in 10 hours. That same job, which was supposed to get over in 10 hours, got over in 8 hours. So, the time saved is 2 hours and the rate per hour. These are the elements that you will need to complete the Halsey and the Rowan scheme. Is that clear? Now, further is the rate of pay. It is basically the rate per hour of a worker. Now, in the rate per hour, you will need the total cost and you need the total hours. Now, when you talk about the total cost, any amount that goes out of the employer's pocket is basically a cost to the employer. You are looking at this from the employer's perspective. So you will add in the basic wages, the DNS allowance, the employer's contribution to PF and employer's contribution to ESI. Be very careful. Employee also contributes the amount to PF and ESI. That is not a cost to you. What is a cost to you is basically the employer's share of PF and ESI. So be very careful. And apart from these, any amounts that you might have paid bonus, gratuity, this, that, all of that will be added, and this will be the total earnings of the worker and total cost to the employer. So we got a numerator. The total number of hours that we will write are the actual number of hours that we have been given to get the rate per hour. Very, very important. Be careful with the employers and employee share. Employer share is what you have to count as cost. Is that clear? Now, the last part is labor turnover. There are three formulas for labor turnover. It is the rate of change in the composition of the workforce. The first method is the separation method. Under separation method, the number of workers who left you or the number of workers that you discharged. You discharged meaning you asked them to go. Both of those are basically the number of workers separated. The number of workers who left by themselves and the number of workers you fired, that will be number of workers separated upon average number of employees. Number of workers replaced, that is the second method. Under replacement method, you will count the number of workers replaced upon the average number of workers on roll. And lastly, the flux method. Under the flux method, left plus replaced plus newly recruited. Now, this newly recruited is purely and purely due to expansion. So whatever is work expanding, because of that, if you got new workers, these are basically newly recruited. So number of works left and replaced plus newly recruited upon the average number of employees on roll. And how do you get average number of employees on roll? Opening plus closing by 2. Simple. Workers at the beginning plus workers at the end divided by 2. That is your average number of workers. That's it. This completes the second topic as well. I'll take a short break and come back with the third one. Yes. Yes, guys, starting with your next chapter, which is overheads. Now, this question usually goes above the head for a lot of people, but let me assure you, there are some simple basic steps that you have to follow for each and every category of question to get your answers. I have listed out everything. Let's start discussing. Now, when you talk about overheads, the first question that you will come across is the distribution summary, where you will make primary distribution and secondary distribution. Now, what happens under there? You have some departments called production departments, some departments are service departments. Now, the first step in the distribution summary is allocation. Those costs which are directly given to you for each and every department, which are known for each and every department separately, are basically allocated overheads. Now, under allocated overheads, Institute gives you a very common thing. They will give you direct material for the production departments and the service departments, direct material and direct labor. Now, please understand, direct material and direct labor of the production department is not an overhead. It is not an overhead. The direct material and direct labor of the production departments is not an overhead. It forms part of your prime cost under the cost sheet. But the direct material and direct labor of the service department are still overheads. The direct material and direct labor are still overheads. Keep that in mind of the service department. Direct material and direct labor of the production department, not an overhead. Direct material and direct labor of the service department, yes, an overhead. Okay. Then comes in apportionment. These are costs which are common for the production and service departments, and you have to divide them on some basis. Now, the basis could be machine hours, labor hours, area, capital value of assets. Depending on the cost, you will have to find a base over there. But the common cost that comes across, factory rent, that you will divide on area. Depreciation of machinery, that you will divide on the basis of capital value of assets. Insurance of machinery, again on capital value of assets. Then you will come across other overheads. Other overheads we usually divide on the basis of machine hours. Then comes in power. Power, be careful of one thing. They will give you HP. If they give you HP, only do that. But if the question has given HP and machine hours, then you will have to do HP into machine hours as the base to divide your power cost. Then there will be some other like employees contribution to PF and ESI. So if it is PF and ESI, then it has to be on the basis of direct wages. Then you have supervisors. Supervisors will be on the basis of number of employees. So these are the common ones which you will come across under allocation. Sorry, apportionment. Then comes in the reapportionment. The first two steps, allocation and apportionment, gives you primary distribution. And the reapportionment is where the service department costs are shifted or transferred to the production department. Now, the service department costs, when they are transferred to the production departments, they are on what basis? So, there are three methods to do that. The first is direct distribution, second is step ladder, third is reciprocal. Now, under direct distribution method, all of the service department costs will be transferred only to the production departments. Under step ladder method, one service department will serve other service departments but will not take service back. Why is it called step ladder method? Because it will resemble like a staircase. It will resemble like a step, which is why also called as a step ladder method or the non-reciprocal method, where one service department will serve everybody, other service departments and production departments, but not taking service back. Okay. And then comes under the reciprocal method. Under the reciprocal method, you have service departments and production departments all serving each other. So service departments will serve production departments and other service departments. They will give service to other service departments, take service from other service departments. Now, under the reciprocal method, you have simultaneous equation, trial and error, and repeated distribution. In the 25 years of papers that I have scanned, Institute has never asked a specific method in the paper to be done. And the easiest of all these three methods is the simultaneous equation method. So make sure that you're doing the simultaneous equation only. Okay. Now, this is what is all of the theory that we just spoke about. The second part of the chapter is machine hour rate, where basically in material you saw cost per unit, that is total cost divided by total number of units. In labor, you saw in labor or employee cost, you saw the rate per hour, that is the total cost divided by total number of hours. And for machine hours, my rate, it is basically total cost upon the total productive hours of the machine. So under material, you find the cost of 1 kg of material. Under labor, you find the cost of 1 hour of labor. And under the overheads, you find the cost of 1 hour of machine. Okay. Now, for the productive hours, what all hours will you be given? You will be given total hours. You will have to reduce the unproductive hours. What are unproductive hours? Maintenance and setup hours are unproductive unless otherwise mentioned. They may sometimes tell you that setup is productive. Then consider it as productive hours. But usually, the maintenance and setup hours are both unproductive unless otherwise mentioned. Okay. Now, as far as the cost is concerned, you will have to add all of the costs. Be very careful with electricity or power. Power will be used only during the productive hours unless otherwise mentioned. And they haven't mentioned any situation as yet where they have asked power to be used on setup hours if they are productive. So basically, you will have to take up power or electricity only for the productive hours. And even if maintenance or setup, any of those hours are productive, they usually say no power is utilized during those hours. Okay. So you will get your total cost that way. You will divide by the total productive hours and you will get your machine hour rate. Now, the third and the last part of the chapter is over and under absorption. How will you get over or under absorption? You will have to find out amount recovered. That is basically how do you get amount recovered? It is the actual hours into absorption rate per hour versus the amount that you have incurred. Okay. Now, how do you get actual hours? This will be given to you in the question. How do you get absorption rate per hour? It will be the budgeted overheads divided by the budgeted number of hours. This will get you your absorption rate per hour. The actual hours are given. You will get your amount absorbed. Amount absorbed means what came to you. Amount incurred is whatever went out. So if you've got more in and less out, you got 100 rupees, you spend 80. You got more, you spend less. that is where you made a profit. Profit is basically over absorption. But you got 80 and you spent 100. Got 80, spent 100 is a loss. Loss is basically under absorption. Acha. In the amount incurred, they may sometimes tell you that there was some obsolete stores written off, there was some paid as per court's order, some award, some this, some that, some abnormal items. You will have to reduce all of those abnormal items because those are technically not overheads as they are in the regular course of business. Are we understanding? So now, which is why the amount incurred is what you will have to be careful about. The amount incurred, you will have to reduce all of the abnormal items. Okay. As far as the amount recovered goes, the amount recovered is basically, as I said, actual hours into absorption rate. They will give you the absorption rate. In case they don't, this is how you'll get it. Okay. Now, is where this flowchart will come into picture. Are there any under or over absorption of the overheads? The answer is yes. Is the amount significant? Yes, always yes. The amount is significant. But if you say no, you will have to transfer the amount to costing P&L and your question is over. That's not what they want to know, right? So, which is why, is the amount significant? Always yes. Is it due to own mistake? The question will tell you that one third, two third, whatever is due to your own mistake, planning deficiency, or a production deficiency, something of that sort. Whatever is out of your own mistake, you have to transfer it to costing P&L account. And if it is not due to own mistake, you will create a supplementary rate. How do you create supplementary rate? That is the amount, whatever is the amount, divided by the number of units. Let's say the amount is 40,000. The units are 10,000. So the absorption supplementary rate is 4 per unit. And with this 4 per unit, you have to charge three accounts. First is the cost of sales account for the number of units that you've sold. So whatever are units sold into 4. Whatever is the finished goods stock, so you will charge finished goods account for that amount. And lastly, the WIP, whatever are the units of WIP into the amount. That's it. You have to know only this much for this particular chapter. And then comes in the next one, activity based costing. ABC is an extension. ABC is actually an extension of overheads. Here, you will have to understand one very important thing, that the most important calculation that you need to have with you is the CDR. If you don't have the CDR, you can't charge the products. And if you can't charge your products, then in that case, it will become very difficult for you to actually execute the cost sheet as per ABC. So the first thing you will have to see, if it's a simple question, they will give you the CDR with you. They will give you the cost driver rate. If they don't, make this table. The activity. First column is activity. It is the name of the cost. Second is activity cost pool. It is the amount of the cost. Third is the cost driver. That is the reason why the cost is going to change. Fourth is the cost driver volume. So for example, I have electricity as a cost. That is my activity. 1 lakh is the cost pool. Reason why the cost is changing is machine hours. I have 10,000 machine hours. Lastly, my CDR. For 10,000 machine hours, my cost is 1 lakh rupees. So my cost driver rate is 10 per machine hour. Are we understanding? So once you have 10 per machine hour over here, this is your cost driver rate, and now you can charge each and every product with it. Are we understanding? So this table is more than sufficient for any question of the institute will ask. Once you have this table, everything will start flowing automatically, boss. Then sometimes the question may ask you traditional costing or absorption costing as well. So for that, you will have to make sure you have the absorption rate. How will you have the absorption rate? It will be the budgeted overheads divided by machine hours or labor hours. That will depend on what the question is saying. If they want the absorption rate on the basis of labor hours, then you have to do budgeted overheads upon budgeted labor hours. If the question is about budgeted machine hour rate, then budgeted overheads upon budgeted machine hours is what you'll have to do. Is that understood? And that is all that you need to know for ABC. I will take a quick short break and come back with the rest of it. Yes, my dear friends, the next topic that we are starting is cost sheet. Now, we have the old and the new format both, but right now I'm only going to discuss the new format. Old format we'll discuss when the need arises. Now, under the new format of cost sheet, whenever you draw a cost sheet, please keep one thing in mind. always and always make sure of writing the units produced and units sold first. Okay, whatever are the units produced and units sold, even if they are the same, please make sure you are writing that first. Then the format of cost sheet, you have direct material, direct labor, direct expense. Under direct material, it is direct material consumed. Opening plus purchase minus closing. This will give you prime cost. Add to it the overheads. First one to add is factory overheads to get gross factory cost. On that gross factory cost, adjust the opening and closing stock of WIP. You will get your net factory cost. After the net factory cost, under the new format, there are 5 items added. I like to call it parks. P for primary packing, A for administration related to production, R is research and development, Q is quality control, S is sale of scrap. But please understand, we are making a cost sheet. The sale of scrap is a revenue, which is why it is written under negatives. Once you have that, you will get your cost of production. You will adjust the opening and closing finished goods. Opening finished goods, they'll always give you the value of it. The closing finished goods, you will always have to cross multiply with cost of production. Why? Why? Because we are following FIFO. Whatever is the opening stock is sold. The current stock that we produce in this year is where we have the closing stock from. So, which is why closing stock always valued at cross of production. You will have to cross multiply to get everything over there. Then comes in the cost of goods sold. After the cost of goods sold, you add in the general administration, marketing overheads under which you have selling and distribution to get cost of sales. Add to it the profit to get your sales. Now, uh, please understand one very important thing. Up to the cost of production, it is for units produced. From cost of goods sold, it is for units sold. So selling and distribution as an overhead is for units sold. General admin is for units sold. And if the question is silent about the admin overheads, it is always and always considered general admin. If the question requires you to have admin related to production, the question will specify what is admin related to production. Okay. Now, there are specific items under each head that you need to know. For example, under direct material, you will also have to add the freight inwards, the insurance and other expenses, duties and taxes if the credit is not available, and all discounts to be reduced except cash discount. Direct labor, all sort of allowances and incentives, your PF, overtime bonus, etc., all of that. Now, the area that you will have the most problem is this. Whether the cost is a direct expense or a factory overhead, that is a problem area. This is where you will find some trouble happening. So please make sure you run this through at least twice or thrice, because this is what you will get the confusion from, and any of the costs that will be in your cost sheet in the paper has to be from these items itself. The only identification problem that you will ever come across is factory overhead and direct expenses. Apart from that, you will not have any problems with any of the identifications. These are the two areas of problem. Okay. I have written down all the other as well, what forms part of general admin selling overheads. But quite honestly, this is not going to trouble you at all. The trouble is only between direct expense and factory overheads, boss. That is the only one. Apart from that, everything is written over here. Just read through it once, twice, thrice, so that it gets stuck in your mind properly. Okay. And that is what we had under cost sheet. Now, the cost accounting system. Again, this is a chapter which everybody hates, including me. Including me. I also don't like this chapter, but this is what we have. So we will have to do it in our syllabus and make sure that we are able to crack the question. It is not necessary, my friends, that you love everything that you do. Sometimes you have to do it for different reasons as well. This chapter, the only reason why you're doing it is for your marks. That's it. And nothing should stand between you and your marks when it comes to your papers. So, your cost accounting system, the important one is non integrated accounting. Now, what are the list of accounts that you have to prepare under the non-integrated accounting? You will start with stores, then I have wages, then I have factory overheads, then I have WIP, admin overheads, selling and distribution, cost of sales, costing PNL, oh, and GLA. I missed out on something. I forgot on finished goods. Sorry. I'll repeat. Stores, wages, factory overhead, WIP, admin, finished goods, cost of selling and distribution, cost of sales, costing PNL, and the GLA account or the general ledger adjustment account, also called as cost ledger control account. Please, 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 guys, make sure you're writing it in the same order. After stores, there has to be wages. After wages, there has to be factory overhead. After factory overhead, there has to be WIP, so on and so forth. Why? Because here we are following the old format of the cost sheet in its exact sense. Old format of cost sheet in the exact sense. Give me 10 minutes. I will revise all the entries with you and I will prove it to you as to how this is a replica of your cost sheet. Okay. Now, the first item of account that we have is the stores account. Under the stores account, how do we pass entries and what are the entries? So, a general rule over here is whatever are in these accounts, you pass an effect for that. Whatever are the real or personal accounts. See, these accounts are all nominal accounts. So, whatever are the real and personal accounts, you will only and only debit or credit GLA for that. So, for example, the first entry is raw material purchase. Now, what do you generally pass an entry for raw material purchase? It is stores to cash or bank or purchases to cash bank or creditors. Now, for the purchases, you have the stores account with you. So, you will debit the stores account. And for cash bank or creditors, they are either real or personal accounts. So, you will credit the GLA account. So, raw material purchases stores to GLA. Raw material purchase return is basically the reverse of that. Then comes in the third entry, which is material issued to production. Your production account is the WIP account. Anything that goes into production is posted to the WIP account. So basically, you're removing material from the stores account, putting it into the WIP account. So entry will be WIP to stores. Okay, WIP to stores. Material issued return, meaning you have issued material to the WIP account, they returned it back. So it becomes reversal of WIP to stores. So entry will be stores to WIP. Please keep it in mind there are two types of returns. One is a purchase return, the other is a issue return. Purchase return goes back to the vendor from whom you purchase. So stores are credited over there, but under issue return, you had issued material to the WIP account, they gave it back. So stores are debited back. So be absolutely careful whether the return is purchase return or issue return. Okay. Then the material is issued to other kinds of either the factory department or the admin office or the sales office. Wherever you have issued the material, that account overhead you debit. So if it is issued to factory overheads, then you debit the factory overhead account. If it is issued to admin department, then debit the admin overhead account. And if it is issued to the sales department, then debit the sales overhead account. So all of the overhead account debit to stores. Okay. Then you have deficiencies found in stock taking. Now the deficiencies could have been of two types: normal deficiency or abnormal deficiency. Normal deficiency will go and sit in your factory overhead account. So entry will be factory overhead to stores. Abnormal deficiency will go to WIP account, costing PNL account. So the entry will be costing PNL to stores. Okay. If the question is silent, we will always consider as normal deficiency. Okay. 10. Under the wages account, you have three entries. It's a two-part entry, but three entries. Part number one, where you incur the wages, meaning you have paid wages. So entry for wages paid will be wages to GLA, because general entry would have been wages to cash bank or cash or bank rather. So instead of that, you have wages to GLA account. The cash bank account is instead of cash bank, which is a real personal account, it becomes the GLA account. And then you will charge direct wages and indirect wages. Direct wages will go to WIP, indirect wages goes to factory overhead. So direct wages, the entry would be wages to GLA and my bad. The direct wages entry will be WIP to wages and indirect wages would be factory overhead to wages. Now, for example, you have incurred 100 rupees. The direct wages are charged how much? Let's say it is charged 60 rupees and the indirect wages are 40 rupees. So how does your WIP account look like? You incur wages first. So entry will be wages to GLA, 100 rupees. You will charge the direct wages where to WIP. So entry will be WIP to wages. So entry would be WIP to wages. So by WIP 60. And indirect wages will go where? Indirect wages will go and sit in your factory overhead account. So entry will be factory overhead to wages 40. Now please understand this. Whatever you incurred is charged. Whatever you incur is charged, which means what? Always and always your wages account will tally. It will never have any balance over here. Okay. Now comes to factory overhead. Any overhead account, for that matter, be it factory overhead, admin overhead, or selling and distribution overhead, any of these three accounts will have two entries. First, the entry incurred and then the entry charged. So factory overhead incurred. What will be the entry for that? The entry will be factory overheads to GLA. Okay, that is what is the incurred entry. The second entry is factory overheads charged. Now, where are these overheads charged? These are charged to their immediate next account. So, for example, coming back, after factory overheads, what account do you have? You have WIP. So factory overheads will be charged to WIP. After admin overheads, what account do you have? After admin overheads, you will have finished goods account. So you will charge the finished goods account. After selling and distribution, what overheads will you have? You will have cost of sales account. So you will charge the cost of sales account. So basically, this is the reason why I have said that you have to make the accounts in the same flow. Okay. Now, oops, 1 second, battery low. Yes. So battery. Sorry. The factory overhead. The first part will be factory overhead incurred. That is factory overhead to GLA. When it gets charged, it will be charged to its next account, which is WIP. So entry will become WIP to GLA. WIP to factory overheads. Okay. Now let's come back to the accounts. Cost sheet. Let's learn it from the cost sheet itself. Where is the old format of the cost sheet? Yes. In the old format of the cost sheet, the only difference that you have is everything is same up to net factory cost. Before the old new format came in, under the old format, all overheads were admin overheads, all of it were production related, and you had the cost of production, you adjusted the opening closing finished goods to get cost of goods sold, and then add the selling and distribution, and to get your COS, add profit sale. Very minute difference, but please understand, in your WIP account, you have recorded direct material, you have recorded direct labor, you have recorded direct expense, you have recorded factory overhead. So your WIP account shows the gross factory cost. If you adjust the opening and closing WIP, you will get the net factory cost from the WIP account. Now, what exactly is net factory cost? Net factory cost is basically the cost of goods that you have produced in this period. These are the finished goods. You put in direct material or raw material in the WIP account, and then whatever is finished goes to the finished goods account. That net factory cost is that particular entry. So the net factory cost that you have is where you will be the goods that you have from the raw material stage, they got converted into finished goods stage. So that is what is net factory cost basically. But it is known under different names under the cost sheet and under the questions. It may be called finished goods at cost, cost of goods manufactured, cost of goods transferred to warehouse, and net factory cost. So it may be called under different names. Okay, all of these names are what they are called at, and the entry is only one. These goods are now finished goods, so they are transferred to finished goods account from the WIP account. So entry is finished goods to WIP. Let's read the next one, which is admin overhead. As I said, all overheads will have two entries: admin overhead incurred, admin overhead charged. The incurred will be admin overhead to GLA, and admin will be charged to its next account, which is finished goods. So when it comes to admin overhead charge, it will be finished goods to admin. Are we understanding? Now, let's come back to again the old format of the cost sheet. One second here. So you have the net factory cost which you transfer to the finished goods account. Now imagine the finished goods account. You have net factory cost. You added your admin overheads. What is admin overhead charge? Net factory cost plus admin overhead is cost of production. And of that cost of production, what you have? Of that cost of production, if you add the opening and the closing finished goods, what you get is cost of goods sold. My dear friends, this is what is cost of goods sold. So your finished goods account shows you the cost of goods that has been sold. Is that understood? So cost of goods sold is what we have in this particular segment in the finished goods account. And that is known by two different names. I'll show you the names. Finished goods account related entries, you have finished goods sold or COGS. Now, whatever is the COGS is charged to COS account. So the entry is COS to FG. Now, COS to FG is what is the goods that you have sold in this particular period. And this is the goods that you have produced. Whatever is produced is transferred to the finished goods account. So entry is finished goods to WIP, and whatever is sold is sent to cost of sales account. So cost of sales to COS is what is the entry. Are we cost of sales to finished goods is what is the entry. Then comes in selling and distribution. Again, two same entries. Selling and distribution incurred will be SND to GLA. A selling and distribution charge, it is charged to its next account, which is COS. So entry will be COS to SND. Okay. Now, final entries are cost of sales related entries. There is only one entry. Whatever is the COS account balance, that is transferred to the costing P&L account. So on the costing P&L account, you have COS over here, you will record sales and you will get either your profit or loss. So what is the transfer entry for COS? All the balance goes and sits under the P&L account. So entry is costing P&L account debit to COS. Then you have sales. What is the entry for sales? Entry for sales is very simple. What do you do in general sales? You will charge either the debtors or cash bank to sales, right? So debtors, cash bank, and we'll put down for that the GLA account. So entry will be GLA. And since we don't make a sales account, sales are eventually transferred to costing P&L, right? So which is why we will transfer it directly to costing P&L. So the entry for sales would be GLA to costing P&L. Okay. And finally, the sales returned at cost. These are goods at cost, meaning before you could actually sell them, you send it to a warehouse and from there it came back. Since it came back from over there, here the entry would be the reversal. Now, since the goods have come back, the finished goods stock has increased. So, finished goods account debited and COS credit. But why are we crediting the COS account? Because, sir, when you sold the goods, the entry was COS to FG. Now, when you have got the goods back, it is FG to COS. Are we understand? Now, what I have also done in this, I have made all the accounts, all of the 10 accounts and the entries that will be there in this particular question. You can go through this and get it done very crisp and clear communication. What all needs to be done in which account is already there. So basically, I posted all of those 20 journal entries in the ledgers for you to understand. Just go through it once or twice and you will be done with the best thing that you can do for non-integrated accounting. Okay. Now, the reconciliation. Now, reconciliation is of three types. Type number one, where they give you all the differences. All you have to do is plus or minus. The type two, where they will give you financial P&L, you will have to do the cost sheet and then find the differences. Under type three, they will give you nothing. You will have to do everything and do the reconciliation. Okay. Now, under type 1, they will give you various adjustments and you will have to figure out whether it is plus or minus. So you will always and always start with profit as per cost books unless otherwise mentioned. Okay. So profit as per cost books is where you will start. And here, even if the profit is a loss, okay, it does not matter. Your signs will not change. Only thing, profit as per cost books negative. Okay. Now this is the cost books. This is the financial books. Okay. Now the common adjustments I have listed on everything. You have overheads under absorbed. Under absorbed meaning what? In your financial books, in your financial books, you write the overhead income. In your cost books, you write the overhead charge. Now let's say the incurred is 100 and charged is 80. So went out 100 rupees, came back only 80 rupees. So it is an under absorption. Now please understand, where have you written more costs? You have written more costs in the financial books. Because of that, the profit of the financial books is less. So what do you do with the cost books? See, basically you have to match the financial books. So since you are higher, financial books is lower, you reduce. So factory overheads or admin overheads or selling and distribution. If they are under absorbed, you less. Acha, a shorter way to understand this, under is minus. If under is minus, over is what? Add. Best thing. But you can do this only and only when you start from the cost books. And you always should start from the cost books. Do not start from the financial books at all. If the question is saying, then do it. Otherwise, do it only as per cost books and start from the cost books. Okay. Then there are some debit items in the financial P&L which we do not record in the cost P&L. So, for example, income tax, goodwill written off, obsolescence, all of these are financial charges. They are written in the financial books. So, because of that, the profit of the financial books reduces. So, and what do you do with the cost books now? You reduce. Exact opposite is with the credit items. Under the credit items, you have interest received, dividend received, something of that sort received, transfer fee, etc. etc. Now, they are written in the financial books credit side. Because of that, the profit of the financial books increases. So you will also have to increase. So add. Okay. Then you have notional rent of own premises. Now, this is notional rents are only and only allowed in your financial books, sorry, in your cost books, not allowed in your financial books. Notionals can be written only in the cost books, not in the financial books. Now, since it is a cost, because of that, the profit of the cost books has reduced, and now you have to match the financial books, so you add this add. Now, stocks are very specific and peculiar. You will have to understand opening stock is written on the debit side of the P&L, closing stock is written on the credit side of the P&L. Or anything that you write on the debit side of the P&L will reduce the profit. Anything that you write on the credit side of the P&L will increase the profit. Are we understanding? Now, please understand this. Uh, this is financial books, cost books. Over here, it is 1 lakh, and over here, it is 1,20,000. You have written opening stock as 1,20,000, which is more in the cost books. Because of that, the profit of the cost books has reduced. You will have to match with the financial books, so you add. But the situation could have been reverse also. So let's say here it is 1,20,000. Here it is 1 lakh. Now, in the financial books, you have written more opening stock. Because of that, the profit of the financial books has reduced, and so you will have to reduce your cost books profit as well. Same is the case with closing stock as well, but closing stock will have a tendency of increasing the profit. Okay, so for example, I am writing 1,20,000 here and 1 lakh here. So closing stock, where is it written more? In the cost books. Because of that, the profit of the cost books will increase. And here you have to meet the financial books, so you less. Okay. Reverse could have been a situation. Now, 1,20,000 is written in your financial books. Because of that, the profit of the financial books will increase. You have your cost books, so you also increase. So, stocks, you will have to be very careful. Only thing that you have to understand is opening stock reduces profit, closing stock increases profit. Okay. Now, in the finance type 2 of your PN reconciliation, they will give you a financial PNL. You will have to probably add the items, adjust the items, make it a key format, and find the financial profit. And then in the cost books, you will have, for the cost books, you will have to create a cost sheet. In the cost sheet, you will use the old format of the cost sheet and draw the entire cost sheet. Once you have the cost sheet, you will get your profit, and then you will have to create your reconciliation same way that they have given you the adjustments in type 1. Type 3 is where you have to draw financial P&L also and cost books also. In the cost books, you will draw 5 accounts, that is stores, wages, factory overhead, WIP, and uh, costing P&L. You will draw these 5 accounts with you and you will put down all the entries that they have given and make your costing P&L. You will get your cost books profit. In your financial P&L, these are the only items that you will have. I can guarantee you, in the last 25 years, Institute has made only one question where they have changed the numbers for other questions and they did the same question all over again. Okay, so here you will have opening stocks of raw material WIP. You will have closing stocks. You have material purchase, labor paid, and overhead incurred. You will have sales, loss on sale of fixed asset, and income from investment. These are optional items. They may or may not be there in the question. Okay. So, other than that, all are mandatory items: opening and closing stock, material, labor, and overheads, and sales. These items would be there no matter what. And then finally, the P&L RICO statement. Here, in the RICO statement, you will have only one entry for sure, which is factory overheads under absorb, and you may have, if there is loss on sale and income, you will have under RICO as well. So if it is in the PNL, it will be in the RICO. Mandatory, you will have factory overhead under absorb. Optional, you may have loss on sale and income from investment, and like that, your RICO will tally. That's it in this question. I will see you in the next one very soon. Yes, friends. The next topic that we are starting is process costing. Now, process costing is a very, very, very format driven topic. All you've got to know is where what comes in. So, here I have divided the topic into basic process costing, where there is no WIP. Then you have statement of equivalent production, where there is WIP. Then you have inter-process costing and some miscellaneous sections as well. Now, what happens under basic process costing? You will have to create a process account, you will have to create a normal loss account, and you will have to create an abnormal loss or gain account. Okay, as the case may be. Now, in the process account, always and always remember this one thing that you will be doing. Always put down the debits first. Whatever are your debits, that is the material introduced, labor, overhead, expenses, other all of those, you write all of that, then record the normal loss, the number of units at scrap value. The moment this much is done, you come down and find the expected cost per unit. How do you get the cost per unit? It is total cost divided by total number of units. But while you are putting the total cost, you will put down all of the debits minus the scrap value of normal loss divided by whatever introduced units minus the scrap units. So here you will get your expected cost per unit. With this expected cost per unit, you will value your transfer, which is transferred to the next process or finished goods account. You will value your abnormal loss or you will value your abnormal gain. It is as simple as that. Now, in case there is abnormal loss, how would your normal loss account look like? In your normal loss account, you will put down one entry from the process account, which is this at scrap value. What will you do with these units? These units are scrap units. You will sell them and collect cash. So the entry will be by cash bank. So entry over here will be cash bank account debit to normal loss account, and those will be the units. Simple. Okay. So here your account will tally, and in the abnormal loss account, you will have one entry coming from the process account. Now, what is the fate of these units? What do you do with these units? These units are also scrapped. If these units are also scrapped, what do you do with that? You will sell the scrap, collect cash. It will be by cash bank at scrap value, and whatever is the balancing figure is basically the loss. So, for example, the expected cost is 100, you collected 20 rupees as scrap. The balance 80 is loss, which is costing P&L. Are we understanding? Okay. Now, in case you have an abnormal gain, you will again have one entry coming from the process account. So the entry will be process account at scrap value. Now, what exactly is abnormal gain? It is reduction of normal loss. So let's say the normal loss expected was 100 units and you have got only 20 units as normal actually lost. So how many units did you not lose? You did not lose 80 units. This is basically your abnormal gain. The savings of loss in the normal loss is basically abnormal gain. Now, since these units are not lost, can you sell them? The answer is no. Why? Because were you able to sell those units? Those are good units. These units were supposed to go bad, but they went good. So now, if these units have gone good, will you sell them at scrap? No. So what will you do? You will have by cash back whatever are the units that you have actually lost, those units at scrap value, and the units of abnormal gain will go to abnormal gain account at scrap value. Now, in the abnormal gain account, you have one entry coming from the normal loss account. You'll have one entry coming from the process account. The balancing figure is your profit. That's it. So, two conditions: normal loss with abnormal loss, normal loss with abnormal gain. If it is normal loss with abnormal loss, no problem. Normal loss, you will have one entry from the process account by cash bank account over. Then for abnormal loss, you will have one entry coming from the process account. That account you will have in the abnormal loss account as well. To process account, at the expected cost, whatever is lost, you will sell those at scrap. The balance becomes your loss. If you are doing abnormal gain, you will have one entry coming from the process account in the normal loss. Whatever are actually lost will be sold as cash bank, and the balance, whatever it is, will be going to abnormal gain account. And in the abnormal gain account, you will have two entries. One is from the process account, and one is the normal loss account, and you are done. Okay. Now, for equivalent production, I have done a 5-step process. Please understand this 5-step process. This works in any kind of question, anything and everything that you have to do. Step number one is where we calculate the abnormal loss or gain. Now, this step is not available anywhere. This is a step that I have created. Okay. So, step number one is where we will put down the opening WIP. Whatever units are introduced, we'll add them and call it units in process minus the normal loss will be your expected output. Now, this expected output is first split as units transferred, then the closing stock. The balance could be abnormal loss or gain. So, let's say the units expected were 10,000, 9,000 are transferred, 500 is abnormal loss, closing stock. So, out of 10,000, 9,000 is your transfer, 500 is closing, so 500 becomes abnormal loss. So you will just have to do this one step and you will be able to get everything over here. What is the transfer, abnormal loss, abnormal gain, closing stock, everything. Now, step number two is statement of equivalent production, where you will have the particulars column and the cost. Now, the cost column will depend on how many costs you have been given in the question. If you have only one cost, then you will write it as cost. You may have two costs where they'll call it material and conversion, or the maximum you will have three costs: material, labor, and overheads. The percentage and the units, the percentage and the units. Okay. Now, if you are following FIFO, if you are following FIFO, the first item that you will write is opening stock, and that will be on the basis of balance percentage. Let's say the opening stock is already done 50-50-50%, or let's say 60-60-60%. Now, that was already done in the last period. So now to complete those units in the current period, you have to add another 40%. So 60% in the last period, 40% in the current period, and that is all. Are we understanding? Then comes in the second item, which is units introduced, completed, and transferred. Those are these units which are opened in these units, completed in these units, and closed in these units and transferred. So the degree of completion will always be 100%. Abnormal loss, the degree of completion will either be told to you. If it is not told, then you can consume it as 100%. And Closing stock, the degree of completion will always be given to you. So always remember this one thing. Opening stock, always the balance percentage. Uh, Units introduced, completed, and transferred will always and always be 100%. Abnormal loss, if there is abnormal loss, it will always be the given percentages or 100%. Closing stock will always be given percentage. If there is an abnormal gain, if at all there is an abnormal gain, the degree of completion of abnormal gain will always be 100% and in the negatives. Okay. Now, step number three, as per FIFO, is where we calculate the cost per unit. Cost per unit is your current cost divided by the equivalent units. Now, in case of material, only in case of material, you will reduce the scrap value of normal loss as well. So here you will reduce the scrap value of normal loss, and everything else, no normal loss to be taken again. So you will do the current cost minus the scrap value of normal loss divided by equivalent units. These are only for material. For labor and overheads, it will be current cost divided by the equivalent unit. Okay. Then comes in step number four. Under step number four, valuation is one of the most important steps. Transfer valuation, very, very important. Now, for the transfer valuation, since we are transferring two types of units, we are transferring the UICT also, and we are transferring the opening stock also. We'll first discuss UICT. Whatever units you have completed in this period into the cost per unit, that is your UICT cost. And for the opening stock, you will first find the opening cost and then the further cost that you have incurred in this period. So basically, let's say the opening stock is 60%. Now, whatever was the cost of that 60%, you will add that plus in this period, whatever 40% you have done. To actually do the 40%, whatever is the cost, you will have to put that too. Okay, so opening stock, you will have opening cost plus the current cost. And in the UICT, it is opened in this period, so only the cost per unit of the current period. Then closing stock and abnormal loss, or for that matter, even abnormal gain, whatever are the equivalent units and into the cost per unit is what you have to do. If you are doing weighted average, if you are doing weighted average, we will have only three entries: transfer, closing, abnormal loss or gain. Transfer's degree of completion will always and always be 100%. Closing stock, whatever is the percentage given to you. Abnormal loss, if a percentage is given, use that. Otherwise, use 100%. And closing stock, whatever percentages are given, use that. If there is abnormal gain, it will always be 100% and in the negatives. So whether you are doing FIFO or weighted average, it will the abnormal gain will always be 100% and in the negatives. Okay. Now, step number three, value cost per unit under weighted average will be opening cost plus current cost. That is how it becomes an average. So opening cost plus current cost, and in case of material, minus the scrap value of normal loss divided by equivalent units, and that is how you will get your cost per unit. Valuation same like you have done for FIFO, no change over there. And lastly, you will create your process account where you have everything. The process account, you will have everything: opening WIP, material, labor, overhead, by normal loss, by transfer, by abnormal loss, by balance carried forward of closing stock, everything. Are we understanding? Very, very simple, very, very manageable. Okay. Now, uh, uh, that's it in this particular topic that we have for process costing, the basic process account, and the equivalent production. Make sure that you go through the format at least once or twice to get it a good hang of it. You get it an idea of as to where what is happening, so that it becomes easier for you to recall and start solving it by yourself. Okay. Now comes in the next topic, which is joint products. Now, under joint products, there are only two types of questions that will be asked. One is the joint cost allocation. The other is your depth of processing. Now, joint cost allocation is as per four methods. The first one is the physical measure method, where we will divide the joint cost on the basis of quantity that we have received at the split off point. The second method is sale value at split off. Under sale value at split off, whatever is the sales value at the split off is what you will use as a ratio to divide the cost. Sales value at split off will basically be whatever are the units into selling price per unit. That is basically your sale value at split off. Okay, that split off value is what you will take as a base to divide the joint cost. Then comes in the third method, which is net realizable value method, which is basically sales at final stage minus the further processing cost to get your net realizable value. Sales at final stage. Okay. So sales at final stage minus the further processing cost is going to be your net realizable value. Now, all of the net realizable values, you will use that as the base to divide the joint cost. In case, in case the a product is not further processed, in case a product is not for the process, then all you have to do is take the sale value at split off as its net realizable value. So basically, net realizable value is how much money finally realizes in your hand. So if you sell at final stage, you will have after further processing, you will reduce the further processing cost. That is your net realized value. If you are selling the product at split off, that is basically your net realizable value. So whatever you get as your NRV, that is what you will take as the base to divide your joint cost. Okay. Now the next item that we have, the next method is a constant gross margin NRV. Here there are two steps. Step number one, we'll find an overall gross margin of the company. So we'll put down total sales of all products at final stage minus the total joint cost and the total for the processing cost. We'll do everything on totality basis. Once we do everything on totality basis, you'll get a gross margin, and then you'll find gross margin as a percentage to sales. Now, once you have that gross margin with you, what will you do now? With that gross margin, first things first, you will be doing what? You will take up now the individual products, sales at final stage. From that sales, you will reduce your gross margin. So it's like going reverse. Sales minus profit is what? Cost. Now, there are only two types of costs in this particular chapter. Either you have the joint cost or the further processing cost. Since you already know the further processing cost, the balancing figure becomes joint cost. Is that understood? It is as simple as that. Okay. Now, next, let's talk about the next depth of processing. Now, under depth of processing, what really happens is they will ask you whether a product is to be further processed or not. Okay. Now, there are two methods of doing it. First method, you calculate the profit to be before further processing, profit after further processing. So now, if you have profit before further processing, what will you do? You will do sales at split off, because before further processing, that is where you will be selling. So you will have sales at split off minus the joint cost to get the profit. If you are doing profit after further processing, then you are selling the sales at final stage minus the further processing cost and joint cost to get your profit after further processing. Okay. Now, wherever the profit is higher, that is what you will do. A shortcut to do the same thing is to compare NRV and sales value at split off. If the NRV is higher, you will sell at for the processing. If the split off is higher, you sell the product at split off. Is that understood? So very, very simple and basic chapter. You just have to use your calculator. Very, very extensive use of calculator in this one. But that being said, a very simple topic as well. So this completes our joint products and byproducts. I will see you in a quick second and we'll start with the next topic. Yes, friends, the next topic that we are starting is service costing. Now, what happens under service costing? You have a lot of calculations to be done, but majority of the calculations are either of the kilometers per day, that will be one-way kilometers into two into the number of trips. Let's say the one-way distance is 20 kilometers. So 20 for going, 20 for coming, that is one round trip into the number of trips that will give you the kilometers per day. Then kilometers per month will be whatever you got kilometers per day into the number of days. Kilometers per annum, whatever kilometers you got in a month into 12 months. And for passenger kilometers, it will be number of passengers into number of kilometers. That will give you one way number of passenger kilometers into two. That will be the passenger kilometers for a round trip into the number of trips will give you passenger kilometers for a day, into the number of days, passenger kilometers for a month, into the number of months, passenger kilometers for a year. Now, the same logic applies for ton kilometers as well. But you'll have to understand one thing. If while coming back, if there are no tons or no passenger kilometers, there would be if there are no tons or no passengers, there will be no passenger or ton kilometers either. Is that clear? Now, only thing that you need to know is the commercial ton kilometers. It is average load into the total kilometers. Just some basic formulas for service costing and you'll be done. Okay. Now, let's talk about standard costing. It appears that there are a lot of formulas over here, but genuinely there are not. Only thing that you need to understand is there are two types of variances: fixed overhead variances and variable overhead variances. Material, labor, and variable overheads are variable overhead variances or variable cost variances. So they operate in a certain way, and fixed overhead operates in a certain way. Okay. Now, how do you get material variances? Whenever you are drawing the standard and the actual, make sure you are doing first the actual units. Why? Because it is a variable cost. Variable cost will be for the actual number of units that you have done. Okay, so you have the standard quantity, that is for these number of units, actual output, how much raw material you should have put in. That is your standard quantity. Standard rate will be usually given in the question, and standard cost. Against that, you have actual quantity, actual rate, and the actual cost, again, which are usually given. Now, if there is more than one material, then you will have total standard quantity, total standard cost, and a weighted average standard rate, which is basically standard cost divided by total standard quantity. Okay, but do not calculate the weighted average actual rate because we don't need it anyway. Okay, now the material cost variance. How do you get material cost variance? How much cost you should have paid versus how much actually paid. Okay, so let's say you should have paid 100, you paid 110. So you paid 10 rupees extra, so it becomes adverse. Okay, split between two variances, which is material rate variance and usage variance. Under the rate variance, what we do is we compare the rates, the standard rate minus the actual rate into the actual quantity. If you paid more rate, then it is adverse. If you paid lesser rate, then it is favorable. And under the material usage variance, we compare quantities. Okay, if you paid more quantity, if you have used more quantity, then adverse. If you have used lesser quantity, then favorable. One thing that you have to keep in mind, all of the variances have to be in amounts. Here, since you are doing standard cost minus actual cost, it is already an amount, which is why we are not multiplying it anyway. In the rate variance, since you have only the rates in the bracket, you multiply with the quantity, which is actual quantity. Now, in the usage variance, since you multiply only with the quantity, you need a rate. The rate that you have to do is standard rate. Okay. Now, the quantity variance or the usage variance is for the split between the mix variance and the yield variance. Under the mix variance, you have to calculate the actual quantity as per the standard mix. Meaning what? Let's say this is 50, this is 50, this is 100, and the total actual quantity is 120. Now, if X is 1500, then how much should it be in 120? So it's like this. If it is 1500, how much in 120? So it should be 60. Let's say the actual quantity is 70. So you have used more quantity than you should have. Since you have used more quantity than you should have, it is adverse. And since in the bracket you have quantity, you will multiply it with the standard rate. Are we understanding? Now, as simple as that, I will repeat again. What you have to do is, let's say this is 50, 50 and 100. This is 60 and this is 120. No, this will be 70 and this is 120. Now, X is 1500. This is what is a standard proportion. That if you do 100 quantities, 50 of it should be X. So, how much should it be in 120? It should be 60. So, you should have put in 60 quantity, but you have actually put in 70 quantity. So, you put in more quantity into the standard rate. That is how you will get your mix variance. Also, one very important thing, you cannot have all adverse or all favorable variances in mixed variance. it will be a combination of adverse and favorable. So if you have uh, let's say two materials, then one of it is will be adverse, one of it will be favorable. If you have three materials, then one will be at least adverse, two will be favorable, or two will be favorable, one will be adverse, something like that. Okay, it will be a combination. And one very important thing, if the standard rates are same, let's say this is 10 and this is also 10, then the mix variance will be nil. Are we understanding? Now, the yield variance is one of the simplest, guys. Yield variance is basically total standard quantity minus total actual quantity into the weighted average standard rate. If you look closely, it is actually a usage variance, but on totality basis. What do you do under usage variance? Usage variance is standard quantity minus actual quantity into standard rate. Yield variance, total standard quantity, total actual quantity into weighted average standard rate. So it is essentially the same, but on totality basis. Now, once you get this, labor is exactly the same. There is only one new variance in labor, which is the idle time variance, which is basically idle hours into the standard rate. And idle time variance will always and always be adverse. Same is with if you have multiple grades of labor. So if you have only one type of labor, then you will have this first table. If you have multiple grades of labor, then you will have the table like this. Now, same thing, cost variance, rate variance, time variance. It has idle time, mix, and yield or efficiency. All the calculations that you've done for material variance are the exact same things that you have done for labor variances as well. No change at all. Are we understanding? Absolutely no change. Then the variable overhead variances, they are same again like your material variances. No change over here. Variable overhead cost variance, expenditure variance, and efficiency variance. The names are different, but the calculations are exactly same for all. So you don't have to worry anything. Once you know material, you automatically know labor and overheads as well. Variable overheads. Okay. Now I'll take a quick second and come back and discuss with you the fixed overhead variance. Okay, one second. Yes, guys, continuing with fixed overhead variances. Now, under fixed overhead variances, you will have four elements. It is DUA. I call it DUA, days, hours, units, and amount. Now, it is not necessary that you will have all the elements in each of the question, but days, hours, units, and amount, these are your maximum items that you will have. And you will have two columns, budget and actual. You'll have budgeted days and actual days, budgeted hours, sorry, budgeted hours and actual hours, budgeted units and actual units, budgeted amount and actual amount. And you have the absorption rates as well. Absorption rates are always on budgeted basis. So for budgeted basis, you will find the budgeted amount upon the budgeted days, budgeted amount upon budgeted hours, budgeted amount upon budgeted units. So if you have days, hours, and units, you'll have three absorption rate. If you have hours and units, you'll have two. And if you only have units, then you'll have only one absorption rate. Okay. Now, the first variance that you have is fixed overhead cost variance. How much money comes in? Absorbed minus the actual. How do you get the absorbed amount? Actual units into absorption rate per unit minus the actual amount. If you have received more, spend less. Receive more, spend less than favorable. If you have received less, spend more. It is a loss. Loss will become adverse, split into two types, which is the fixed overhead expenditure and the fixed over volume variance. Now, in the fixed overhead expenditure variance, it will be the budgeted amount minus the actual amount. And in the volume variance, you check for units. Budgeted units minus actual units into absorption rate per unit. If you are doing more number of units, then it is favorable. If you're doing lesser number of units, it becomes adverse. Is that understood? Then comes in the three variances under the volume variance: calendar, capacity, and efficiency. Calendar variance is the days, budgeted days minus actual days into absorption rate per day. See, you have to follow the matching concept over here. And sorry, here you have quantity, so you multiply by absorption rate per unit. Here you have days, so you multiply by absorption rate per day. Then the capacity variance, it will be budgeted hours for actual number of days. Whatever actual number of days that you have worked, how many hours you should have worked versus how many hours you have actually worked. Okay. And into the absorption rate per hour, because now you have the hours in it. And the efficiency variance talks about budgeted hours for actual units. Budgeted hours for actual units. That is the actual number of units that you have done. For that, you should have taken how many hours into the absorption rate per hour. Okay. Now, a lot of people get confused over here as to whether the variance is adverse or favorable. I'll give you a very short hack. Consider yourself studying. You were supposed to study 25 days, you studied 27 days. You studied more number of days. If you studied more number of days, will it be adverse or favorable? Favorable. Here, you were supposed to study 1000 hours. You studied 1200 hours. You have studied more number of hours. Adverse or favorable? Favorable. Fixed overhead efficiency variance. You should have completed your syllabus in 1000 hours. But you took 1200 hours to finish your syllabus. You took more time to finish your syllabus. Just imagine yourself studying. If you are studying more number of days, if you are studying more number of hours, and if you take more time to complete your syllabus, with that you will never ever go wrong. I can guarantee you that. Is that clear? Then you have sales variances, but that is only for one question. You'll have budgeted unit selling price, actual unit selling price. You have sales value variance, that is total sales minus budgeted sales minus actual sales, and selling price variance and quantity variance. Same stuff, nothing different. And with this, the chapter gets over. I will see you in the next one very soon. The next chapter that we have, guys, is marginal costing. Under marginal costing, there are a lot of formulas. We'll compress them and put it all over here. The first is the format of CVP analysis, where you write sales, which is selling price per unit into number of units, minus the variable cost, which is variable cost per unit into number of units, to get, sorry, contribution, which is contribution per unit into number of units. From that, you will reduce your fixed cost and get your profit. Now, there are some formulas here. How can you get contribution? You can get sales minus variable cost, or you can do also profit plus fixed cost. Contribution per unit, only one method, selling price per unit minus variable cost per unit. Okay. Now, PV ratio, there are multiple methods of PV ratio. Right now, you need to know only two. Either you do it on totality basis or per unit basis. So, if it is on totality, you will do contribution upon sales into 100. If you want to do on per unit basis, it will be contribution per unit upon selling price per unit into 100. So, this is your PV ratio, and whatever is the PV ratio, the balance will become the variable cost. Whatever is the PV ratio, balance will become the variable cost. Okay. Now comes in the break-even point. Now with the break-even point, it will be what? Fixed cost divided by contribution per unit. This will get you the break-even point in units. If you want break-even sales, you can do what? BP units into selling price per unit. Or for break-even sales, you can do one more formula, that is fixed cost upon PV ratio. So if you do fixed cost divided by contribution, you will get the break-even units. If you get do fixed cost upon PV ratio, you will get your break-even sales. Okay. Then comes in margin of safety. The margin of safety is basically how much sales are over and above the break-even sales. So you can do it multiple ways. You can do total units minus the break-even units, or you can do profit upon PV ratio to find MOS. Then this chart is very, very important. This is something that I have done myself. Your total sales are split between two types of sales: break-even sales and MOS sales. Break-even sales into PV ratio will give you fixed cost. MOS sales into PV ratio will give you profit. So break-even sales into PV is fixed cost. MOS sales into PV is profit. With this, there are multiple formulas that you can draw. But always remember this. All of these are formulas out of the basic formula. So total contribution, total sales into PV is total contribution. Total sales split between break-even sales and MOS sales. Break-even sales into PV is fixed cost. MOS sales into PV is profit. That's all. Okay. Then you have the change formulas. You can do change in profit upon change in sales, that is again PV ratio, or you can do change in total cost upon change in units to get variable cost per unit. Okay. All changes in fixed cost to be done on totality basis. All changes in variable cost to be done on per unit basis. Then you have the indifference point. The formula for indifference point is extra fixed cost upon the savings in variable cost. Now, how is it to be interpreted? Below the indifference point, choose the option with the lower fixed cost. At the indifference point, you can choose either. Above the indifference point, choose the option with higher fixed cost. Is that clear? Now, last thing, shutdown point. Shutdown point is avoidable fixed cost upon the PV ratio. How do you get avoidable fixed cost, you ask? Avoidable fixed cost is total fixed cost minus the unavoidable fixed cost. So total fixed cost regular minus the unavoidable is avoidable fixed cost. Divide that by the PV ratio. That is your shutdown point. And same like in the inference point, you will have interpretation over here as well. So here, what do you do? Below the shutdown point, shut down the shutter, meaning shut down. Above the shutdown point, open the shutter, meaning operate. At the shutdown point, you can choose either. So you can keep it half open. You want to run, not want to run, on you. Are we clear? This is what you have for shutdown point. And this completes your chapter. Now, last chapter of our revision, budgets and budgetary control. Here, you have flexible budgets and function budget. Under the flexible budgets, you will be given budgets at various levels, and you will be asked to make budgets at another level. So you may be given one or two budgets, and that is basically the static budget. From that, you will have to change it and bring a budget to a new percentage level. For that, they will have to tell you whether a cost is fixed, variable, or semi variable. If they don't tell you, you will have to identify. Please keep it in mind, all direct costs are variable, and if you have budget at more than one level, you will have to mathematically see whether the budget is fixed, variable, the cost is fixed, variable, semi variable. How do you see that? Variable cost is the same on per unit, fixed cost is the same on total, and semi variable cost is same at neither. Okay, it is neither same at any of the levels. Is that understood? So variable cost per unit is same, fixed cost total is same, and semi variable cost nothing is same. Is that clear? Now comes in the second part, which is functional budgets. Functional budgets will always start with sales. Sales plus closing finished goods minus opening finished goods will get you your production budget. Production budget into the kgs required will get you consumption budget. To the consumption budget, you will add the closing stock of raw material, reduce your closing stock of raw material to get your purchase budget. Now, please keep this in mind. Everything over here is in units. When you do the purchase budget, it is in units. You multiply by purchase price to get the purchase budget in rupees. Is that understood? And then you may be asked labor budget as well. The starting point of labor budget is production budget into the labor hours will get you your labor budget in hours into the price. Please, for God's sake, do not write opening closing stock here. Alright, this is labor, not material. You can't store labor. So keep that in mind, okay? So once you get the labor budget in hours, you multiply it with the rate per hour to get the labor budget in amount. And that is all for the budgets. For the production budgets, you have two types. Two types of production budget, type 1 and type 2. In type 1, they will tell you 70, 30, 80, 20, something like that. That is production budget type 1. If they don't tell you anything like that, then it is production budget type 2. Okay. Lastly, the budget ratios. You have three budget ratios: capacity, activity, and efficiency. But you don't have to remember all of it. Always remember ACE. A is equal to C into E. Activity is equal to capacity into efficiency. Okay. Now, how do you get capacity ratio? It is the actual hours upon the budgeted hours. How will you get efficiency ratio? Standard hours upon actual hours. Activity ratio, you don't have to remember. Now, if you want to do budget ratios, you need to know three types of hours. One is standard hours for actual output. Second is, of course, actual hours. And third is the budgeted hours. The moment you have these three, you will be able to get your capacity, activity, and efficiency ratio, all of them. Only remember ACE. A is equal to C into E, and that is all. Well, with this, I finish my uh, revision. I hope you understood everything. If you haven't, please put down a comment. I will reply back to it, and I will make sure all your doubts and queries are done. And we also do a lot of other activities. You can start and be a part of it as well. This was CSAS Nimeet with the signing off. I will see you very soon with flying colors. Till then, tata, bye bye.